Hey, it's Tom here and welcome back to the channel. So in 1989, Peter Lynch came out with the first edition of this book, One Up on Wall Street, and it was really the first time that many investors had been exposed to this term 5-bagger or 10-bagger, which is basically a stock that returns 5 times or 10 times your money. And Peter Lynch argued in this book that really a lot of everyday investors, kind of mum and dad investors, have a lot of insights potentially that professional investors don't have. They can see new businesses emerging in their cities, and they can kind of get in early on those businesses and go along for the ride as they expand and grow across the country and perhaps even internationally. And Peter Lynch famously made some of those investments in businesses like McDonald's and Walmart and Dunkin' Donuts. And then we also had a couple of books that kind of throw the 5 and 10 bagger out the window and take it even a little bit further. Firstly, we had Thomas Phelps write a book called 100 to 1 in the stock market, looking for stocks that, as you can probably guess by the title of the book, return 100 times your money. And then we also had this sort of updated version from Chris Mayer called 100 Baggers, which is a case study of the absolute holy grail of investments, where he found over 300 stocks that returned 100 times your money. And if you want to be successful as an investor over a long period of time, you really only need a handful of Peter Lynch's 5-baggers or 10-baggers, and you really only need maybe 1 or perhaps even 2 of Christopher Mayer or Thomas Phelps stocks that return 100 to 1 in the stock market. So these are topics that get a lot of views on YouTube, a lot of retweets on Twitter, and it's kind of a hot topic that everyone loves to discuss, is the 5-bagger and the 10-bagger and the 100-bagger. But we very rarely hear people talk about the 1,000-bagger simply because they don't really exist all that often. Stocks that return $1,000 for every $1 that you put in take an extremely long time to play out, and there are very, very few case study examples of companies that have been that successful over a long period of time. But in this video, I want to focus on one in particular, and one 1,000-bagger stock that I want to look at in this video is a company by the name of NVR. Now, I find NVR a really fascinating case study because of a few different reasons. Firstly, it was written up by a very well-known value investor by the name of Norbert Lou, right back in June 2001. He did a short write-up on the Value Investors Club for NVR, posted it up there. He'd been buying it in his mum's retirement account since the late 90s, and in 2001 he shared this idea publicly on sort of the Value Investors Club, and it's become one of the most famous write-ups on the Value Investors Club. And the business model today is almost identical to what NVR were doing back in the late 90s and early 2000s. And NVR is a stock that I've basically added to my watch list after kind of digging into it in the last just week or so. And I've found that they've basically done 3 things extremely well in order to produce absolutely mind-blowing returns. 1,000 to 1 almost returns since 1994, which I'm going to share some numbers with you on that very shortly. So the first thing they've done is basically they've executed 2 out of 2 of the criteria from Chris Mayer's 100 Baggers book. Now, Christopher Mayer basically explains that you really only need 2 things for a 100 bagger. You can kind of do it with one of these things potentially, but you really need both of them working in sync to kind of make life easier to try and find a stock that really returns 100 to 1. And the criteria are pretty straightforward. Basically, the first one is you need earnings growth. It's very hard to have a stock go up 100x if the underlying business is not growing. Stocks are not lottery tickets, as Peter Lynch would say, and they really do follow earnings over a long period of time. So the first thing you need is earnings growth, and ideally the second thing you need is multiple expansion. So if you buy a business at a PE of 10 times earnings, and then 5 or 10 years later it's trading at 20 times earnings, you've got to double in the stock just from that multiple expansion alone, and you don't need the earnings to grow as fast to get to kind of 100 bagger status. So in order to get to 100 bagger status, if the PE has doubled, if you've gotten that multiple expansion, you now need a 50x, which is still a lot of growth. You need a 50x in earnings in order to get to 100 to 1 kind of return. So if you get a 50x in earnings and you get a 2x in the PE ratio, 50 times 2 is 100, and you've kind of got where you need to be. Now, interestingly, NVR has actually done both of those things. It's had roughly a double in PE ratio, maybe a little bit more than a double since 1994, and it's had phenomenal earnings growth. Its earnings alone are up about 90-fold. It's grown earnings from about $10 million in 1994 to about $900 million in 2020. But the other thing that NVR has done exceptionally well in order to propel it from what would have been 100 or 200 bagger status to almost 1,000 bagger status is it's made, frankly, exceptionally good use of its shares, and more specifically buying back shares religiously. From 1994 through to 2020, they've had an 80% reduction in the shares outstanding. So that, in other words, is basically a 5x in terms of your proportional ownership in NVR if you're a shareholder right throughout that time. The entire NVR pie is growing as earnings have expanded and as PE ratios have expanded, and you not only own a bigger pie, but you also own a bigger piece of the bigger pie because of all these phenomenal share buybacks. So let's go back a little bit and talk about why Norbert Lou from Punchcard Capital was such a big fan of NVR back in 2001, and some of the factors that have allowed it to be such a successful investment and continue plowing money into share buybacks as well as growing the underlying business. So like I mentioned earlier, NVR is a home builder. Now, home builders are typically very cyclical kind of businesses, and you can imagine that through the financial crisis and the housing crisis in 2008 and 2009, there were a lot of bankruptcies with home building type companies, or really any business relating to real estate in 2008 and 2009 was getting dragged through the mud somewhat. So these businesses are cyclical, and you really do have to be careful when you invest in these types of companies. But NVR had a couple of characteristics that made it really attractive to Norbert Lou. So in many ways, the typical home builder is almost like a property speculator in disguise. So what most of them do is they go out and just outright buy a plot of land, build a home on it to, certain specifications and so on, and then they sell that sort of house and land as kind of a package. So that's sort of the typical model for most home builders in the US, and it means that as the real estate market goes up, which most of the time the real estate market is kind of steadily going up, it means that these home builders can generate extra earnings and extra growth of wealth for their shareholders through the steady appreciation of these small land holdings that they have for short period of times as they're building out these projects. Now, one of the problems with that is that when we do have a downturn, that kind of steady growth in assets can turn into quite aggressive drops potentially, exactly like we saw in 2008, 2009. And it means that these home builders really are very exposed to the housing market. But NVR took a slightly different approach to that, or actually a very different approach. So rather than buying land outright when they were building these projects, they instead chose to buy an option on the land. They didn't want to buy it outright, they didn't want to outlay a lot of capital, and they didn't also want to leave themselves exposed to sort of the ebbs and flows of the real estate market, and they didn't want to be dragged through bankruptcy if we did have some sort of crisis, because even though they didn't see 2008 or 2009 coming, this is in 2001 we're talking about when these write-ups were done, the management team at NVR had seen cycles obviously in real estate in the past, and even fairly modest downturns had been really, really bad for a lot of home building companies. And that was almost as simple as the thesis was for Norbert Lou. You had a much more capital light home builder than the typical home builder, but at the same time it was kind of just thrown in the same basket as the average home builder. And for that reason, it was trading only at about 5 to 7 times earnings most of the time. It was trading at a deep discount to where Norbert Lou thought a really capital light growing business, high return on equity, high return on capital company really should be trading. Another thing that caught Norbert Lou's attention is that they weren't only executing really well on the business side of things and growing the company and continuing with this nice capital light model that really didn't expose them to housing downturns and so on. They were also buying back stock like crazy. And even today, if you look at some of the key stats for NVR, they don't pay a dividend, but they do plow a lot of money into share buybacks. So the summary of Norbert Lou's thesis all the way back in 2001 was basically you have a good business returning a high return on equity, you have it trading only at about 6 or 7 times earnings, and you have it plowing a lot of money into share buybacks, and it's growing with very little extra capital required to do so. It kind of has all the stars aligning beyond the fact that it's maybe still a little bit cyclical in terms of its earnings. It's not going to go through the big ebbs and flows like a lot of home builders do that own the actual plots of land, but still there is some cyclicality, and that's kind of actually why if you go and look at some of the comments on that NVR write-up back in 2001, still a lot of people on the Value Investors Club weren't huge fans of it, but now if you go back and look, there's a bunch of comments kind of congratulating Norbert Lou on how well it has worked out. And just one more thing on sort of the actual buying an option on the land rather than buying it outright, just to show you how effective that was in terms of kind of getting through and surviving some of these downturns. In 2008, 2009, NVR was still profitable. Now, if you just step back for a second, think about how much turmoil was going down in the real estate market in 2008, 2009, particularly in the US. It's just mind-blowing to think that a home builder can still be profitable. And one of the main reasons for that, like I say, is they didn't own the land outright, and they didn't have all of the kind of plummeting land values hitting their balance sheet and all that sort of stuff. So in 2007, NVR produced about $330 million in net income. In 2008, 2009, that was still down a lot. It was down to about $100 million in net income. But to survive that type of period is impressive. To still be profitable through that period is very impressive. And it set up NVR very, very well to kind of get back to growth and start thriving again after the financial crisis in 08-09. So I find the wildly successful investment of NVR absolutely fascinating. This is a stock that would have been a 100-bagger even if it wasn't doing share buybacks. Like I say, the PE roughly doubled, actually a little bit more than doubled. Net income went up 90 times. It went from 10 million to 900 million. So if you combine just those two things, you have a 90x in net income. You have a little bit more than a double in the PE ratio. You get close to about a 200-bagger just from those two things. But NVR were making also extremely good use of consistently plowing money into share buybacks. They recognized that the stock was cheap, as Norbert Lou did. It's a really good business, earning 15 or 20% return on equity, and it's trading at like 7 times earnings, which is just amazing to think of today. So they bought shares back like absolute animals, and they continue to do so. And you basically had a 5x in your proportional ownership in the business after those buybacks, if you're looking from 1994 through to 2021. So they bought back about 80% of the shares outstanding. So if you combine all of that together, you have the double from the multiple expansion, you have the 90x, call it 100x for simplicity, from net income, which gets you to 200x, and then you have a 5x in your proportional ownership from all the shares that got bought back, which gets you to the magical land of 1,000-bagger. Just absolutely mind-blowing returns. And to put those returns into sort of compounded growth rate type numbers, if you had held NVR from 1994 through to 2021, it's gone from about $5 a share to about $5,000 a share with that 1,000-bagger return. That is 29% per year compounded, which is a lot better than the very long-term track record of Warren Buffett. So to put it in those terms, it's absolutely just mind-boggling numbers that we're dealing with here. So for me, there are a couple of kind of key learnings from this whole story. I'm unfortunately about 20 years late to NVR. I'm not a shareholder in the business, but it is one that I've added to the watch list today. It trades at about 17 or 18 times earnings. The business is still growing, and they are still buying back shares. So they're still really running this engine, but it's potentially or almost certainly not as cheap as it was back in 2001 when Norbert Lou did his write-up. And I really have to do a bit more work to figure out just how long the runway is to kind of continue this compounding engine. So it's certainly one for the watch list for me. It also really shows the power of share buybacks. Obviously, it would have been a hugely successful investment if they didn't buy back a single share, but you got about 5 times the return you would have gotten because they did buy back shares and they bought them back at very cheap prices, 10 times earnings or less, and now they trade at closer to 20 times earnings. So they created a lot of value for shareholders that way. And it really goes to show that if you're going to be a net buyer of stocks generally, share buybacks aside, if you're going to be a net buyer of stocks generally, you really don't want expensive stock markets. You don't really want your stocks to go up a lot. Maybe you want your own stocks to go up a lot, but the general market stays low and depressed. Ideally, you want sort of perpetually cheap markets, so you can keep buying into businesses that are going to yield very highly on your initial capital. And that's a concept that I've heard a couple of investors mention now. Chris Bloomstrand, who is an extremely long-time holder of Berkshire Hathaway, has talked about how he basically thinks Berkshire Hathaway has kind of been perpetually cheap for a long period of time. And he's really over the moon that Berkshire are now doing a lot of share buybacks and starting to return capital to shareholders in that way. So that's it from me for this one. Like I say, this was a fascinating story for me to kind of dig into with NVR. 5 baggers are great for your financial health. 10 baggers are phenomenal. 100 baggers will get you basically to retirement, and 1,000 bagger stocks are just mind-blowing, and that's like, you know, I guess depending on what you start with, that's potentially private jet money. I don't quite know. That's fascinating story to look into. That's it from me for this video, and I will see you in the next one. Cheers.